Okay, good. I think it's 7:05. In the interest of time, allow me to start the webinar. Again, karibuni sana. My name is Linda Makatiani. I'm your host for today as we get to discover ourselves. Yeah. Through this webinar, our aim is to be able to get to understand our investment profile. So I think all protocols observed, all religions respected. We'll start with a short word of prayer just to say thank you for this day. Heavenly Father, we thank you for this day. We thank you for guiding us and protecting us and bringing us here. As we start the webinar, we ask for your wisdom and help us to be able to learn and share and impact not just ourselves, but those around us as well. Thank you and blessings. Amen. Yeah. So we'll start off. As I said, my name is Linda Makatiani. I'm an investing coach and a financial literacy trainer. I'm very happy to be your host for the day. This webinar is brought to you in partnership with VUCA. And let me just take a minute to appreciate VUCA for coming on board and agreeing to partner so that we can be able to spread and promote financial literacy amongst ourselves, get people to start looking into investing, not just on their product, but, just in the capital markets in general. So thank you very much, VUCA. And I think on behalf of the team at VUCA and myself, karibuni sana, again. Yeah, so through this webinar, what we'll be trying to discover is who am I? Yeah, and that's a question I'm posing to all of us here today. Who am I? And this is in regards to your investing journey. Remember, investing is a journey, and when you're going through this journey, you obviously want to be able to know what's expected of you, what's up ahead. You'll be required to make certain decisions. So you need to understand, so who am I? What are my expectations throughout this journey? And that's the question we aim to answer today. So, get that light bulb moment where you discover, oh, so this is who I am when I'm going through my investment journey. And we start off by just defining, we said the webinar is about cracking the code, getting ourselves to understand who am I throughout this journey. So the first question we ask ourselves is then, what is an investment profile? Yeah. And your investment profile is a comprehensive overview of all the factors that collectively affect your investment decision making. When you're faced with a decision that you make, do I buy X or do I buy Y? Do I look into the risk and rewards of this investment, or do I look in this other one? The process that you go through as you decide which route to take, that now constitutes your investment profile. So it's all the different factors that come together affect the decisions that you make as regards your investments. That is what we define your investment profile at. I hope that is as simple as possible. As for me, I always try to make my trainings, my instructions as simple as possible to get all of us to understand where we are. Now, before we even now go into these factors that affect our investment decision making, we look at what is investing. We have to understand, we are talking about investment profile, we are talking about investment journey. So then we need to be able to first understand what is investing. And investing is the allocation of resources with an aim of either generating profit or generating income. So you're looking, these are my resources. I want to put these resources here. I want to buy this asset and I'm giving it some time. So you are allocating your resources, and during that time you've allocated your resources to that asset. You are looking at, is it going to generate me some passive income? And passive income is where you've allocated resources to an asset, and that asset promises to pay you periodic income over the period of that contract. So let's say you've bought, you're looking at, let's say you've bought a bond, and this is a 5-year bond. So within that 5-year duration, that asset, which is the bond, is promising to give you periodic income. The bond will pay you every 6 months. So periodic income, every 6 months, you'd be getting some income by virtue of being the holder of that asset. Now, the other bit again is allocating resources for apologies on that. I hope I'm back. Oh my God, I don't know what is happening. Hello, I am back. Can you hear me now? I hope you can hear me. Good. Thank you. Technology issues. Allow me to go back to the presentation and we can continue where we stopped off. Again, my sincere apologies on that. Good. So saying we were looking at we're talking about what investing is, because even before we discuss the factors that affect, that form our investment profile, we need to be able to understand what investing is in the first place. And we talked about investing being, allocating of resources, one, for passive income. And we said passive income is where you are allocating resources for now the asset that you have bought to be able to generate you income, periodic income in the duration of you holding that asset. So if you're holding the asset for 5 years, then there's some expectation that in periodic times, you're going to be getting income from that asset. And we gave the example of having a bond. If you have a 5-year bond, then you're able now through the 5-year bond, every 6 months, it would be paying you coupon, and that coupon now becomes your passive income. The other way, again, investing is you're allocating resources to also generate a profit. So you could be buying an asset and your projections have shown that this asset is going to appreciate in value. And once it appreciates in value, you are able to sell it and through that, make a profit. So you get some gains out of it. So let's say you've bought, it could be stocks. Let's say maybe you bought ABSA stock at 12 shillings, it appreciates to 18 shillings, you sell at 18 shillings. The difference between your buying cost and your selling cost becomes your capital gains. It could be land that you have bought somewhere that maybe is going for 800,000. The place that you have bought land is being developed. A school comes and sets up there, a hospital comes and sets up there. Now the demand for that area goes up, and maybe later on now, 2-3 years later, you decide, I'm not looking to develop this land. So what you decide to do, you decide to sell it, and maybe by then you're able to sell it for about 1.5 million. So the difference between the 800 and the 1.5 becomes your capital gain. So that is what investing is. You're putting your resources in an asset that's either going to generate you income or give you a profit. Now, when we talk about investing, investing does not take place in space. It takes place in an ecosystem. So it's also very good to get to understand when I'm investing in Kenya, who are the key players that I need to be aware of, and know what their role is. So when you're investing in Kenya, you're participating in the Kenyan capital markets landscape as an investor. And this whole system is regulated by the Capital Markets Authority. So the CMA, Capital Markets Authority, is a regulator. They're the ones who license the players in the capital markets. They regulate, they monitor, they supervise. So now that they become the key, at the top there on that landscape, that's the regulator. Then you have key players, the Nairobi Securities Exchange. So if you're investing in stocks, in bonds, and you need to buy and sell, the exchange platform that your trade goes through is provided for by the Nairobi Securities Exchange. These trades needs to settle and need to be cleared and settled. And that takes place at the Central Depository and Settlement Corporation. We know it that as the CDSC. So that's another key player. As you're in the investment landscape, you need to know what the role they play. Then if you're investing in stocks or you want to sell bonds in the secondary market, you come through and you have to now engage the services of a licensed broker. You have the investment banks as well coming in to put together transactions that can bring products, new IPOs and new products into the market. Then you have the fund managers as well, managing the collective investment schemes. What we normally know. I think one of them is that is very popular to all of us is the money market funds. And then you have digital digital platforms like VUCA, bringing rate products now out to investors like us. So these are key players. And then, of course, there's you as an investor as well. So coming into that. So you get to understand who are all these players and what role they play in the investing landscape in Kenya. Yeah. And then as well, you get to know, so what's available for you to invest in? Yeah, you get to understand at the end of this session, you'll have understood what your investment profile is. And now you're starting to look at what options are there for me to invest in. So you have options of stocks. This is buying shares into companies that have come into the market and said, we want to offer a bit of our shareholding out to the public. In return, we get some money from them. Once the companies make money, they give back to their shareholders in the form of dividends. You have the option of buying fixed income assets. Those are the treasury bills and the treasury bonds. You can invest in collective investment schemes, the unit trusts. As I said, one of the ones that we popularly know is the money market funds. Then you can also invest in real estate, physical real estate, where you're going out and buying land, you're going out and buying property. Or you can invest in REITs, and REITs are companies that operate income-generating real estate. So you buy units into those companies, and when the underlying asset, which is now the real estate, makes money, part of that profit that they've made is passed on to you in the form of dividends as a REIT holder, yeah, which is now one being our partner here today in today's webinar, VUCA. So I think we move on to now looking at our investment profile. We said our investment profile is all factors that together guide our investment decisions, affect our investment decisions. Now, what are these factors? 4 key factors, there are actually 5, but the 5th one is what we are here doing. So we look at it towards the end as well. So the first one is your goals. And second is risk. We're looking at time as well, and funds. So we want to look at each of them nicely and carefully so that we're able to understand what role they play in forming our investment profile. So let's start off with goals. And goals are specific objectives that we set out to achieve through our investments. Yeah. So as you're thinking about your investment, you must have a goal. There's an end goal that you are looking to achieve. I want to put my money in bonds. Why am I putting my money in bonds? Because investing in bonds will help me to plan for my retirement in one or two ways. Investing in stocks. Why would I invest in stocks? Because if I invest in these stocks, either once or twice a year when the company declares profits, they might pass on part of that profits on to me as a shareholder in the form of dividends. That becomes passive income. I am looking to maybe put some money together, invest money so that at some point in the future, I'm able to cater for some education costs for my children or even for myself. Yeah. So these are objectives that you are looking to achieve. And you have to be very smart when you're setting out your objectives, because your objectives will help shape the strategy that you will apply. How do I plan out what to invest in, when to invest, when to withdraw from my investments, and again, what percentage do I, of the funds that I'm putting aside, do I invest in bonds, and what percentage do I put in equities? That becomes your asset allocation. Yeah. Because if I'm looking to invest for retirement, then I'm going to look for an investment option that is long-term, because retirement is a long-term objective. Yeah, if I'm looking for passive income, I look for short to medium term. Education as well, dependent on when you would want to be able to achieve that goal, then again, you're looking at options that it will either be medium term or long term. So that's how it plays out. Yeah, so goals are very important. They play a very big role in your decision-making process when it comes to investing. So that's the first one, your goals. And then secondly, we look at your risk profile. Now, your risk profile is trying to understand what's my comfort level when it comes to market volatility. One thing we always have to understand that when it comes to investing, there's always the potential of risk. Now, if there's potential of risk, different investment options have different levels of risk. When you get to understand those different levels of risk, then you get to know which of these am I comfortable taking up, because I'm able to tolerate their risk level. Yeah. If I have a low risk tolerance level, then I'm going to be inclined to invest in assets that have a low risk level. If my risk tolerance is high, then I would be willing to look at options of investing in assets that have a high risk level. So now that's how. And remember again, it's okay to start off with investments with a low risk level, because as you're in your investment journey, you're gaining more experience, you're gaining more exposure, you're becoming more knowledgeable on the risk and the rewards of other different options that maybe you've not invested in yet. And your risk profile now evolves. You become more confident through your experience, your exposure, and your understanding of the risks involved in the different investment options. And now you're able to adjust or maybe take on slightly more risk as you go about your investment journey. I always like to emphasize that you can start. It's okay to start with investments with low risk profile, but also be open to the fact that as you go on, your confidence grows, your understanding grows, your experience grows, your exposure grows. And then now you're able to start looking into investment options with other risk levels. So that's the second factor, your risk profile. Yeah. How much are you willing to take? I always give the example of, investing is not a one-day thing. I will not put my money here and, I'll get capital gains today and I'll get my passive income today. It is a journey. It's for a duration of time. And during that duration, I have to sleep, I have to wake up, I need to do so many other things. So as I'm going about doing all these other things, the market that I have invested in is facing, there are fluctuations happening. There's so much that's going about. Maybe my investments are appreciating in value, then maybe in a month or so, they depreciate, the value of the asset that I've invested in goes down. So it's understanding what's what am I capable of taking up without disrupting my normal day-to-day life as I go about, trying to earn more money to invest even more. Getting to understand that is very, very key. There are various exercises you can undertake to be able to understand that, ask yourself questions here and there. What would you do if I was to tell you that you can invest in this, but the probability of you losing 10 or 20% of your capital is high? Would you go into that investment or not? That helps you gauge, as at now, what's your risk tolerance level, right? So we said first, one of the first factor is your investment goals. What are you looking to achieve? And now we've added now a second factor, which is your risk profile. And this is what's your comfort level on the market volatility when it comes to possibility of you losing your part of the investments that you've put yourself in. Now, the third factor is time. And time, this is the duration that you expect to hold the investments before you need the funds. So you're looking at, and this ties into your goals, yeah? Because if you're looking at short-term goals, then you'll be looking at short-term investments. So if it's short-term, if I'll be requiring this money in the short term, then I'm looking at what investment option will be able to make me some money, but also give me an opportunity to be able to get my money back in the short term, within the year, maybe in 1 year or 1.5 years or so. So if you're looking at a duration that is short term, then you'll be more inclined towards deciding to invest in treasury bills, because those are 3 months, 6 months and 1 year, or money market funds, which are flexible for you. If you're looking at medium term, we are talking of 5 years, 7 years or so, then you're looking to make investments in assets like bonds, medium term bonds or stocks, or in rates now. But if you're looking at long term, then you're looking at investing in assets that you can hold on for the long term period. And those would now be looking at options of long term bonds, stocks as well in the long term, and then you're looking at maybe as well real estate and such. So, and when you're thinking of time, it's also to understand that you also need to take time as well to periodically review your investments. When you are talking about your risk tolerance, we mentioned the way that as you go through your investment journey, you're getting more experience, you're getting more exposure. But even as you go through your investment journey, that time that you're in your investments, things are changing. Your financial circumstances are changing. You end up maybe achieving one goal and you set another goal. Sometimes you have to readjust a goal. So it's coming back and reviewing your investments, looking at it like, I put this as a medium term. Now, can I be able to say, maybe for this bond, I am willing now to stretch myself a bit more because my circumstances, my financial circumstances have changed. And now I'm looking more on the long term. So now that starts playing a factor in your investment profile as well. So time is very important. How long are you willing to hold on to the investments before now you have to liquidate and use maybe the funds now to achieve the goals that you had set. So, and now fourth is funds, the money that you have available. And when it comes to funds, again, you're looking at 2 key questions. You're asking yourself, how much am I willing to comfortably set aside to invest? Yeah. And for me, I always say, again, I emphasize investing is a journey. It's not a one-off thing. And if you're able to decide how much you're able to comfortably set aside, and it could be on a periodic basis, then that means you factor it into your budget, and it becomes part of your daily or your monthly habits when you're doing your budgeting and everything. And when you do that, then you're able now to, again, enjoy the magic of compounding, because you keep on investing now and then. So it's not a one-off thing. You'll come with a lump sum and put and hope for the best. The best strategy always is to think I have these funds now, but then that does not mean that next month or 2 months down the line, when I get some money, I cannot be able to put that money down into investing because I already invested in June. Yeah. So it's always looking, what am I comfortable to put aside to start investing? And then again, reviewing to see how can I be able to continue investing. So you put aside money in June, in July, you get some money, you put aside and you invest in something. In August, you do that. And then now you start, and that's how you start building wealth. The second question is asking yourself, how quickly can I convert these investments into cash? Yeah. So when you're looking at these investments that I want to invest in, you're thinking, I'm putting these investments, we had said on your time is you have, there's short term, there's medium term, there's long term. So if I'm looking at short term, then I'm looking at being able to cater for short term emergencies. So I cannot be investing, or at least I should not be investing into an asset that has a long-term view and is not liquid. Liquid, I mean, the way ice converts to water when you leave it sometime. So think of your asset as ice. And when you want this ice converted to water, when you want this asset converted to money so that you are able to cater for your short-term emergencies, how easily are you able to do that? Yeah. So the different investment options have different liquidity levels. So there are those investment products that you can easily convert to cash. If I open my VUCA account today and invest in rates, and maybe 4, 5, 6 months down the line, I want to be able to liquidate, then I can go in and sell my units and I'll be able to get the cash and deal with my short-term emergencies. If, let's say, for example, I take my money and I invest in land, I buy land somewhere. If I need money in the short term for an emergency, it will take me a while to be able to go look for a buyer for the land, go through the legal process, changing the ownership and all that, getting that payment. My emergency would have been, way out of my depth. So it's looking at, and that's how now funds also come into play when you're deciding. So why should I invest in stocks? Why should I invest in rates? As opposed to buying a real estate property like that? Then, so the liquid aspect is very, very important. So you said when it comes to funds, you're asking yourself 2 questions. How much can I comfortably set aside to invest? And this also plays a role when you're thinking, what should I invest in? If I'm investing in stocks, is there a minimum amount that I need to invest? Not really. When you're investing in stocks, it's largely dependent on what stock am I buying and what's the current price. And amount is minimum shares I need to buy is 100 shares. So if it's 2 shillings, I'll need maybe 250 to start off like that. But when you're investing in something, an asset like bonds, T-bills, minimum investment is 50,000. Then that means I have to have that 50,000 to start investing in it. So you see how now that comes into play when I'm deciding what do I invest in. I might want to invest in bonds, but as of now, I don't have the 50,000 to be able to invest in bonds. I might want to invest in land, and I've singled out the land that I'm interested in investing in, but that land costs 400,000. Do I have the 400,000 now to enable me to invest in that property? I may not have that. So now that's how fund plays that role. And as I'm looking as well as, yes, I might have the 400 as well to buy that land, but this 400, I might need it in the short term for my emergencies. How easily, how quickly can I be able to sell that land and get my money to deal with short-term emergencies if and when they occur? But if I'm thinking mine is long term and this land is there and I have money, I can quickly make that decision and say, yes, the prospects for this area looks good. There's a hospital coming up. There's the roads. There's a road that is being built here. There's water. There's electricity. There's a school plan here. So it's going to appreciate in value. Let me buy it. But you're thinking long term, yeah. So that's how now the funds come into play. So a very key thing to as well be able to remember is you need to be able to balance your short-term objectives and your long-term objectives. And that's why I say short-term, you're looking at emergencies. I'm saving so that this money that I'm putting aside, yes, it's earning, it's growing, but I'm able to easily access it in case I get emergencies in the short term. Yeah. So which investment options are there for me to be able to invest, make some money in that investment, but I can easily access. So I'm looking at, okay, so short term, then that means I'll be more inclined towards investing in, I'll be looking at the money market funds, the unit trust, either money market fund, equity fund, bond fund, balanced fund, momentum fund, whichever option you're looking at in terms of that whole sector. Then you are looking at maybe T-bills, the short term. Do I maybe just do a 3-month T-bill or a 6-month T-bill or a 1-year T-bill? That, something that I know in 6 months, if I need the money, my T-bill would have matured, I'll be able to get the cash. And then on this other end, I'm also able to balance out and say, okay, so fine, I can put some money to help me build wealth. Because the longer your investment stays, the more you're likely to earn from it. And with that, it helps you to build long-term wealth. So if you're able to balance out the two, I have these funds I'm putting aside. So part of the funds goes into my emergencies, my short-term, and part of the funds goes into building me long-term wealth. Yeah, very important for you to have a well-rounded investment profile. You need to take both into consideration. And I would say, from my experience, this is one of the bits that we hear when we hear of negative investment stories. This is one of the reasons why, because we don't take time to understand our investment profile and the role that funds and time play in our investment profile. So we quickly go into an investment because we're just looking at the returns. And when we look at the returns, we forget to look at the duration that this investment needs us to stay invested. So you will buy a 10-year bond that's giving you 18% because you're looking around and seeing, okay, maybe the other options are giving you 14, 15%. But you're forgetting the fact that this is a 10-year. Yeah. So within 3-4 years, if you need that money, how are you able to liquidate that asset to get your money back? And most of the times we find that at that point that you want to liquidate, that you need your money, and you had invested in an asset that is predominantly long-term, which is not easily liquid, then, and you're busy looking for someone, the market conditions then are not favorable. And because you are in distress and you really need the funds and to sell, you end up having to sell at a loss. Yeah. And then now you're looking at and saying, oh, investing is not good. I'm not making money from it. I bought stocks or I bought a bond and I had to sell at a loss. No, this is it. But it's because you did not take time, like we all are right now, to be able to understand the factors that affect our investment profile. What are these things we need to consider as we are deciding on as we're making investment decisions throughout our investment journey. So we've talked about those four. We've talked about your investment goals. What are the objectives you're trying to achieve? We've talked about your risk profile, understanding your risk tolerance. And we've said as well, again, as you go through your investment journey, you gain more experience, exposure, and it changes. So you can start off with assets with the low risk profile. And then as you continue in the journey, you can accommodate more. We've talked about time. How long are you willing to stay invested? And a very important consideration when you're making your investment decisions. And then we've talked about funds as well. So how much am I willing to put aside and how quickly can I convert these assets that I'm investing in into cash as and when I need. Yeah. Now, the other one that plays a key role as well in forming our investment profile is our knowledge and experience. And as I said, that's what we are here today. Because as you gain more knowledge, as you gain more skills in understanding what really is my investment profile? What really are these investments options that are out here for me to invest? Your level of familiarity with these products influence your choice of investments. As you're starting out, it's always advisable to start out your investment journey with products that you understand. You're always told invest in products that you are able to explain to a child if they asked you, what is a bond? Why did you buy the bond? You are able to explain to them in the simplest of terms. And that, you see, that's how that affects your knowledge, affects your investment decisions. But then again, it's also to note, but that does not mean that you cannot invest in the other options, because as you start with the investment products that you understand, that these are the risks, these are the rewards, this is the best strategy I can employ to get the best out of my investment in this asset. You start off with that, but as you go on, then you're gaining more familiarity with the other investment options that are there. Yeah. And then now you're able now to start incorporating other investment products into your investment portfolio. And that's how you get to grow, because diversification, of course, is very important. We've mentioned throughout the session how different investment options have different rewards. They cater to your different goals. And all that. So it's also good as you go through and you're getting more knowledge and you're getting more experience, you're able now to incorporate different investment options into your investment portfolio. So those are the 5 main factors that make up your investment profile. Yeah, those are the main 5 main factors that together will guide, that affect your investment decisions. Okay. So then we look at, this is just to get us to understand the percentages, rough percentages at which the different factors affect our investment decision making. Again, it's to also know that these different factors, in as much as they affect our decision making process, they are individualized. And that's why we say personal finance is very personal. So for me, my risk profile might take a really big percentage when I'm deciding what investment to go into. I'll be like, okay, I have the money, I have the knowledge, this is the goal I want to achieve within this time, but I am going to place a lot of emphasis on my risk profile, because for me, I want to be able to go throughout my day, knowing that I've invested in this and it matches my risk profile. And this, again, evolves with time as you move on. We are always progressing. You start off, if I am willing to, maybe I start investing with, let's say, even 10,000 shillings. I get a promotion and I'm able to allocate maybe now 30,000 shillings to my investments. Then I'm looking at all these other things. I get to 50,000. Then maybe it will be now my funds, because I'm like, okay, now I can look at bonds because I have the financial muscle to be able to invest in it and get the rewards that I want in it. So it's understanding that it's your specific circumstances and it's your risk, it's your preferences, but all this change, they evolve, and they're based on your changing financial circumstances and also the evolving market conditions. So they always shift. It's not cast in stone. So what are the 3 main? I think just to finish off, it's to get to now ask to understand the 3 main investment profiles. And now you're able to, having gone through, your goals. And I hope as you are going through the session, you are also now taking time to understand, to ask yourself, so what is my goal? I want to invest. What is my goal? My risk profile. What is what's likely to be my risk profile? In terms of time, how long would I give myself when I start investing? In terms of funds, yes, how much am I willing and ready and comfortable putting aside and all that. So now putting all those, my knowledge, getting more understanding of the investment options that are out there. So now putting all that together, now from this, we are able now to decide where do you place yourself, which of this is your investment profile. So the first one is a conservative investment profile. This is where you as an investor, you're prioritizing your capital preservation. This is my 10,000. It's my hard-earned 10,000. Yes, I want returns. I want good returns for this money that I'm putting aside to start investing. But I'm not willing to take on a lot of risk for that. Yeah. So I am okay with going and investing in investment options that have low risk level. They might give me, just maybe low, medium, but stable returns, and I am okay with that. So if you're that kind of person, that's the approach you're comfortable taking through your investment, then, excuse me, your investment profile is conservative. So you're looking at investment options that are giving you some assurance of this money that you put in there. If you want it, the least you would get is at least your money back. Yeah. So you're likely to look at options like investing in treasury bills, investing in treasury bonds, because now their risk level is very low and they're good for capital preservation, and the money market funds as well. So that's your conservative investment profile. And then there are those of us who would be on the moderate investment profile. This is where you're basically looking for a balance between growth and risk. So yes, I have my money I want to start investing. I want to get good returns. And for these good returns, I'm willing to take a certain amount of risk to be able to do that. Because I understand, of course, the more risk, the more likely the reward. So, but you're looking to take calculated risk and on a moderate level, because you understand this is my risk profile, my risk tolerance is there, low, medium, and because I understand the risk associated with this asset, I understand the rewards associated with it as well, then I am willing to take in a bit more risk just to be able to have my asset grow in value. So if you're that kind of investor, if that's your investment profile, then you're more likely to invest in dividend stocks. You'll be looking to invest in the rates. You're looking at the bills and the bonds. So taking on moderate risk, so that you can get on just a slightly more in terms of returns for your investments. And then we have the one with the bold, very bold investment profile. This is that who says, for me, I'm going to prioritize higher returns. So I understand that the higher the risk, the Okay, apologies. I hope I'm back now. Wow, apologies. I hope I am back and you can hear me. Yeah, so we're talking about now the bold. We've talked about the conservative investment profile. We've talked about the moderate risk investment profile. And now we are looking at the bold investment profile. And this is that who says, for me, my priority is going to base it on higher returns. I understand that I have to take a higher risk to be able to get higher returns, but I'm focusing on the growth that I want my investment to be able to achieve, and I'm comfortable with that volatile environment that I have to be in to invest in for me to get the returns that I'm looking at, for that growth that I'm looking for. And when we talk about taking on risk, we are talking about taking on calculated risk. Yeah, not just looking at the return, but taking on calculated risk. This is risk you have analyzed and seen. Yes, it's the potential of me getting an X amount in terms of growth for my portfolio is this, and this is the risk that is associated with it, and you are comfortable with that. So this would be an investor who's looking at growth stocks because of the volatility that is associated with growth stocks. You're looking at real estate because, again, there are areas that you do not really know if the value is going to appreciate, how long it's going to appreciate, and all that. Yeah, so those are the three main. Yeah, so those are the three main ones. And I think now just to finish off, that is to say thank you. Apologies for all the disruptions. And first, just allow me to appreciate VUCA as we finish off, just to say, thank you to the VUCA team for coming on board and partnering in this. I think it just goes to show that they're living true to their name because, VUCA means to cross over, and they're, through this act, they're helping us as potential investors to cross over to the point of being, good, empowering us with the financial literacy skills that we need to be able to make informed investment decisions. And for that, we appreciate them, and we look forward to, and I personally look forward to, more partnerships in all of that. We will go through a few questions before. I think we still have time to go through a few questions. Let me look through the questions that are there. But those are my details. Even as we go through the questions, those are my details. You can reach out to me if you want. I do a lot of investment coaching just to get people through investments and financial literacy trainings as well. So it would be good to engage you. If you're interested in getting to know more about VUCA and rate investing or just investing in general, please do reach out. We can have a whole session. I'm also inviting you for my next masterclass. For that, get more information on my website as well. Yeah, so we'll go through the questions. And thank you for being here throughout this time. And so going through the questions, let me see. Rahim, what affects the percentage return on rates? Are they government influenced? Now, the returns on rates are based on the returns of the underlying asset. Maybe just in brief, the underlying assets. I think what we'll do again is we'll see if we can be able to schedule a session where we can have the VUCA team coming in and talking us through that whole rates as a product. But I think just in simplified form, the returns on what you get as now dividend once you invest in rates is based on the returns that are there that are gotten on the underlying asset. And the underlying asset is really the real estate, the income generating real estate that the investment company has invested in. Now for the in the case of VUCA, it's the Kwetu and the Kajani properties. So as the Acorn Holdings are generating profit from that, part of that profit is passed on now, passed on to you, to us as rate unit holders in the form of now dividends. So it depends. It's the same as what happens with the stock market as well. In the stock, you're investing in a company. The dividend that the company pays out is largely based on what profit the company makes. And then now they decide the percentage that they would want now to pay, or to pay now to pay in their shareholders. So you say there's one who's asking, if someone earns 100,000 net, how much is comfortable amount to invest? Now, this is a budgeting question because if you're earning a net of 100,000, you have to look into, so that's your income. What are your basic expenses? How much do they cost? And then, you're looking at your other expenses. Then you're looking at how much now you're comfortable to set aside for investing. When you are looking at the factor of funds and you said, how much are you comfortable setting aside? That largely has to do with you having done your budget. Yeah. Because I cannot say now invest half of it and maybe likely your budget allocation, your basic expenses is another 50%. So then what happens? You will not have any money for, other auxiliary needs, your auxiliary expenses, going out, you transport and all that. So this, it's best answered on a case-by-case basis. And once we've had a look at your budget, what are your needs, what are your basic expenses, and that. Then one asks, can or should one risk profile change with time? Now, there's your risk tolerance and there's your risk capacity. Now, your risk capacity changes with time. And the reason why I'm saying that is because if you think about it, if I started off investing and I had 50,000 shillings, and maybe, you come to me and you say, I can invest, let's invest in this thing. Let's take your 50,000, invest this, but the risk of that investment is very high. I'm not likely to go into that risk because I'm thinking this is all I have to invest. Yeah. But if with time I reach the point where maybe now I have 1,000,000 shillings and you come and tell me this investment needs 50,000 and the risk is very high, I'm more likely to consider investing in that because I know I still have 950 to be able to invest. So that becomes your risk capacity. So that changes with time. Your risk profile evolves, yes, based, as we said, based on the experience and the exposure that you get. And that's why sometimes you'd start off with investments that have a low risk level. And then as you keep on investing and you're getting more knowledge and understanding of how to manage the risk of these other investment options out there that have a slightly higher risk level, then you're able to now to start consider investing in them. Where can one find the slides for future reference? So I'll have this on my YouTube channel. I'll share it with that. And again, I'll just send you through for now. You'll be able to access it at a later date. What is the best financial advice you have received? I'm a financial advisor, but I do receive financial advice as well. And I think the best is start as early as you can. I'm also a parent, so best advice as well is to start your young ones as early as you can. Yeah. Explain to them financial literacy in the simplest way with examples that they can understand. But I think that's the best that we can do for ourselves, for our families, for our society, is to try and bring up a generation that is financially literate from a very young age. So I think that's the best. And that forms part of the aim why I do this myself as an individual. My company is called Finance for Families because I'm trying to get families to talk more on investing, to talk more on finances, to get even the young ones to understand, to build on their financial literacy skills when they are from a young age. Yeah. So, and I hope that answers. Yes. And the one I normally give everyone, the financial advice I give everyone, when you're part of such a session and you've gotten insights, please share it to the ones around you. As I said, I'm going to have this on my YouTube channel please share that with those around you who maybe for one reason or another were not able to make it here today. That's the way we can be able to promote financial literacy in our society, get everyone to be able to make those smart investment decisions, grow ourselves, grow our families, grow our clans, grow our society, and grow our economy through that as well. Yeah. What's the difference between bills and bonds under conservative and those under moderate? When you're looking at an investment profile that is conservative, you're basically, you can consider both. Conservative is those ones. For me, it's capital preservation. When you're looking at bills and bonds, part of the features is they do preserve your capital. I'm investing in a bond. I put in my 200,000. I know at the end of the maturity of the bond, I'll get my 200,000. In between, I've been getting some level of income. So it's just looking at those ones. It does not mean that if an investment option falls under one investment profile, it can't fall into another. So if you have a bold investment profile, it does not mean that you cannot invest in bonds, you cannot invest in T-bills. You can, but when you're looking at the composition of everything, the investment options that you are considering, then you now have a wider scope to consider. Yeah, I hope that answers you. Faith asks, where would you invest a lump sum of 5 million for retirement? Now, this, again, with this question, we would need to be able to sit down and understand. So it is retirement. How old are you? When are you likely to retire? And then now do the calculations to see how much would you comfortably need to cater for your expenses post-retirement, and then now work backwards to see, so we have 5 million, what investment instrument can we put this investment that can be able to, in those X number of years, at that point, start or keep earning, keep building, and keep generating that passive income for you too. So this is highly individualized. I would not say, okay, invest this in bonds, because I don't know how old you are. I don't know what your expenses would be when you're investing, when your expenses would be when you retire and all that. So for that one, it would need a personalized session where now we can be able to go through all that. How would you get started investing in VUCA? For that one, I will share a link. And as well as I've said, I do have sessions where I take clients through all the investment options that are there, and investing in rate is one of them through VUCA. So we can be able to go through that in detail and then start you off investing in VUCA. What's your view in investing in government bonds? Is it still a good idea? Yes, but now again, as we said, the factors that will affect your decision making would be, so why are you investing? What's your ultimate goal for investing? What's your risk level? Again, you find you have to think about, do I have the money to be able to invest in it? But yes, it would be, but it's dependent on these factors that affect your decision making. So again, this is to be able to have a proper understanding of where you're coming from, your current financial state, so that now we can plan out your investment in it to see if it's the best investment option. Now, I'll tell you from experience, you have clients who say, I want to invest in bonds, but when it comes to my portfolio, and this is like the different investment options that you have invested in. When it comes to my portfolio, I want to allocate the least to bonds because it's so boring. There's nothing I'm doing there's no activity. I put money, I put my 200,000, it's a 5-year bond. All I do is every 6 months, it's going to be paying me coupon. So maybe then it's to decide this coupon that I'm being paid, where does it go? There are people who want that level of interaction. So someone would say, I prefer investing in bonds. I prefer investing in stocks because the stock prices are always moving. I feel like there's activity in my investment profile, in my investment portfolio every now and then. So we are all different. We all have, we all employ different strategies. We all have different investment profiles. So we would prefer one over the other. Yeah. Is the masterclass physical? No, the masterclass is online, but you can reach out and I can give you more information. This is an online masterclass, and a complimentary that comes with the masterclass as well is once we are done with the masterclass, you get a free session with me where now we get to sit down and do now your investment profile. So that comes complimentary with the masterclass. So is it advisable to do fixed deposit or invest in mutual funds? So each of them have their different benefits, and it depends on what you're what's your ultimate goal for that one. If you're investing in mutual funds, at times, because you would have the option of looking at it from, I want to invest in this fixed deposit, what return is it giving me? How liquid is it if I'm investing it for the short term? Then if I'm investing in mutual funds, what return am I getting? And then, you do a comparison of both. Beatrice is asking, do you offer classes as a group or individual? Yes, I do. I have several packages. I take you through investing. I can take you through the full personal finance. I talk about budgeting, savings, investing, and I do that for individuals. I do that for groups. I do that for families. As I said, I'm very passionate about getting people to up their financial literacy skills, getting families and groups to talk, chamas, to not just come together and pull money and put in a bank account, but to figure out how can we be able to grow this and grow our funds as well. Okay, I think I've answered most of your questions, and in the interest of time, if I do get to see any other questions, I'll answer them through that. But thank you so much for being part of today's session. Do follow me on my socials at linda.makatiani, Instagram, Facebook, LinkedIn, Twitter, TikTok, and my YouTube channel as well, where I get to share more information on specific investments. I'll also be hosting more of these sessions where we get to discuss in depth and maybe now start looking at the investment options that are there one by one, so that, as we said, part of your investment profile is your knowledge and your experience. So, get to help you build your knowledge and experience. But with that, thank you very much for attending, and I look forward to hosting you in future webinars. Thank you again to the VUCA team for partnering with me on this. And I hope to be able to partner in more. If you have any questions, please do reach out. Any questions on investing, do reach out. My number is there. My email address is there, and I look forward to engaging with you. But with that, thank you and have a good night.